General Accepted Accounting Principles, or GAAP, are established accounting principles issued via the Financial Accounting Standards Board, also known as the FASB. The desire to have an established accounting standard stemmed from the market crash of 1929. Multiple agencies have been created throughout the years to enforce these rules, but the FASB has been in charge since 1973 and works with the private sector in creating, adapting, and enforcing these rules. The mission behind the introduction of GAAP principles was to improve the clarity, consistency, and comparability of financial information. This information could be a company's quarter-over-quarter finances, finance between competing companies in the same sector, and even whole industries. With this information, investors can understand how competing companies are doing against each other, as well as give investors the peace of mind that the company isn't trying to get creative with their earnings numbers just to boost the share price. The Securities Exchange Commission, or the SEC, has required that all public companies in the United States follow the GAAP rules when reporting their financial statements. Failure to follow these accounting principles can result in a public company being removed from a public exchange. These general accounting principles are set to standardize accounting definitions, assumptions, and methods when it comes to calculating finances. For example, what is considered revenue, or which line item research and development costs fall under? Or here's one, what is allowed to be considered a depreciating asset? Well, you might notice that these companies also release non-GAAP metrics in their earning reports. These are metrics that companies are allowed to present to investors without following the rules of the general accounting principles. However, the company must disclose to investors that these additional metrics do not follow the rules and are open to interpretation. Companies sometimes report these non-GAAP metrics because they believe the GAAP rules are not flexible enough to handle their company's specific operations. Investors should always take non-GAAP metrics with a grain of salt because they have the potential to be used in a misleading manner. If you're ever wondering what the GAAP and non-GAAP metrics are for your favorite stocks, or you want to compare these metrics between companies like Tesla and Ford or Advanced Micro Devices and Nvidia, well, Seeking Alpha has these metrics for premium users in the Seeking Alpha factor grades. Plus, you'll instantly see how a company's GAAP and non-GAAP metrics compare to their sector, as well as their 5-year average. This can help you determine if the company is a leader or a struggler in the competitive landscape. The quant system also gives you a simple grade between A+ and F to make it even easier to know if this metric is strong or weak compared to the other data points. So the bottom line, GAAP accounting principles were designed to keep investors' trust in the public markets by establishing rules that companies must follow when reporting their financial statements. This provides clarity, consistency, and comparability between quarters, companies, and industries, helping investors make smarter decisions with the facts and not just the guesses. If you like this video, make sure you watch the other investor videos we have on topics like market cap, SPACs, and direct listings. And we'll see you in the next video.